Tēnā koutou, tēnā koutou, tēnā koutou katoa. Kia ora and welcome to this session, which focuses on value for money. I'm Helen Skinner. I'm Head of Responsible Investment at ANZ Investments, but we're not talking about that today. We are very much focused on value for money, a topic that is pretty hot at the moment, I'm sure you'll all agree. Now, I would like to point out that a certain person who remained nameless and maybe on the panel said that there was a high risk of this turning into the Red Wedding. And for those of you that aren't Game of Thrones fans, essentially all the characters get murdered. So I'm really hoping that's not going to happen today. But we've got some great professionals here, so let's just quickly run through them and introduce. I have here Paul Gregory, Director of Investment Management in the FMA, who will soon be the new Executive Director of Responsible and Enforcement in the new year. So congratulations, Paul. We have Harry Koprivcic, sorry, CEO at Guardian Trust. We have Noah Schiltknecht, on the end there, sorry, Noah, from Makao. We have the lovely Sharon McKay, who's Head of Third-Party Distribution at Fisher Funds. And on the end, we have Tim Williams, Partner at Chapman Tripp. So welcome all. So we'll kick straight into questions, and we'll start with you, Paul. So can you just run us through why did the FMA publish this guidance? What's the background behind it?
Thanks, Helen. So it's the reason why we publish the guidance is because managed funds are an increasingly critical way for New Zealanders to engage constructively with their financial and broader well-being. With home ownership becoming decreasingly likely as a source of future wealth, New Zealanders need access to suitable, well-managed, good value managed funds. So that's why we publish the guidance. So with that as context, start with a couple of things that the guidance isn't. It isn't pushing the industry to passive, and it isn't a race to the bottom with fees, because otherwise the reference point would have been fees rather than net performance relative to a market index. So the guidance is really clear, more than once. That value is not about cheap. It is about what the investor or the KiwiSaver member receives in return for the risk they're taking and the cost they're paying. And the key value lens in the guidance, it's not the only one, but it's the main one, and in how we and the supervisors have been implementing the guidance since it's been published, is on risk-adjusted net performance over a time that's meaningful for the fund and therefore for the investors in that fund. Because that's why New Zealanders use managed funds, it's why anybody uses managed funds, and it wasn't apparent at the time that we did the guidance or before that is the typical experience for retail investors in New Zealand managed funds. And using the net risk-adjusted performance lens gives latitude, of course, for fund managers to articulate and demonstrate their value. It doesn't champion cheap or passive. Return after fees relative to an appropriate market index allows for fee size, it allows for investment style, it allows for investment strategy, and it is also visible, concrete, and objective. And we don't think that approach is controversial or even novel. And it's also the focus of independent directors, of investment committees, of portfolio managers in the industry, and it is also the focus, rightly, of the institutional clients. So thanks.
Okay, we've got a lot to dive into there, but we'll kick off with Harry. So this was published back in April 2021. So what have supervisors been doing since then?
Quite a lot. So when the guidance came out, I think the critical thing for supervisors and the FMA and the industry was to try to achieve a consistent approach to this review. That was critical to us. We started engagement very quickly with the FMA, and it was decided that the best way to kind of do that is by doing it. So we decided to run a pilot where we chose 14 schemes across different types of products and ran that through. That pilot obviously uncovered certain areas where what can be improved and how we could approach with this review. We also incorporated some of the feedback from the industry as well, and from those managers that have provided that took part in the pilot as well. And we revised our original framework that was built. I think we had to tweak it and make it more workable for the industry. we had further consultation with a wider industry and on revised tool and a framework as well, and we have incorporated a lot of other feedback that was received from the funds manager. And we have started since then. Once the framework has been better in place, the engagement has started between supervisors and their supervised entities. But I think that engagement has already started soon as the guidance was published. Even before the tool came out, there was already engagement as to how this could be approached and what are the issues that we could encounter during the review, in particular the first year, because I think, first time around, there will be a lot of areas that might come up for the discussion, which we talk about it later, but it was quite important. I think the main focus for the supervisors is to try to, and FMA, to try to achieve a consistent implemented approach for this.
Okay, I'm sure we're going to have a lot more conversation about the framework in itself, so wry smile from Sharon there. But first of all, let's go over to Tim, and Tim, I imagine that a lot of the audience here are pretty familiar with it, but can you just give us a really quick summary of the legal implications of this?
Yes, some of the reason I'm here, I think, is because there's been a bit of discussion about whether the report is encouraging the industry or telling the industry that the law requires them to do something. And I think it's in the former category in some areas and the latter in others. So we've had some very constructive conversations with the FMA about all of this, and we've at times agreed to disagree, and at other times I think there's been a consensus. The points that differ, I guess we differ on, or actually we'll start with where we agree. So first of all, KiwiSaver, there are obligations not to charge an unreasonable fee. The regulations define that as being significantly higher than other comparable funds or offering or schemes. So there is a comparative basis with other similar types of funds. So I think that accords with some of the messaging and the detail that the FMA is producing in its report. But when you look at significantly higher, you start saying, okay, well, that's got to be someone who's an organisation that's charging fees that are an outlier compared to the norm. So it's not really a commentary on overall fees across the market. It's more identifying outliers, which is a point that I think needs to be emphasised. Getting back to a bit more technical law, if that wasn't technical enough, the point where we disagree on is in relation to non-KiwiSaver schemes. Our view is that the justification that seems to be given for this is that the fund managers have a duty to act in the best interests of members. But we would make the point that that duty is only when to be exercised or required when the manager is exercising powers or performing duties. And what they charge for exercising powers and for performing duties is not actually subject to the best interest duty, if you read it literally. So there's a bit of a difference, I think, between KiwiSaver schemes and other fund managers as far as obligations around fees go. Fees are going to be constrained by competition, and to support that there's a lot of obviously disclosure requirements around fees that will back up and allow the market to make its own assessment of fees in that area. But as I said before, KiwiSaver is different, and why is that? Well, the government has subsidised KiwiSaver, as we all know, so that gave a good justification for the government to be a bit stricter on fees being charged in that sector than in relation to other managed investment schemes. We did actually talk about this when the legislation was introduced in 2012 with MB as to the meaning of best interests, and we put it to them that best interests, if I was not to charge a fee to a customer, that would be in their best interest, so how can this sit? And we were assured at the time that best interests did not extend to fees. So that's one of the backdrops to my interpretation of the law there. So in relation to commissions, which is another part of the paper, if the commissions are being charged to the member or the scheme, then we believe that the best interest duty does apply to that because that's an operation of the scheme. Whereas if it's the manager paying out of its remuneration particularly for introduction or referral type commissions, Our belief is that those are not caught by the best interest duty at all. But this is now over to the supervisors to unravel all the knot. I think it is important to make a point that the FMA suitably is asking the right question without indicating any particular answer, and asking supervisors to confirm things, because as we know in the marketplace now, it's not only doing the right thing, it's about demonstrating you're doing the right thing. And for confidence in the industry, it's important that fund managers do demonstrate that their fees are reasonable.
Show us, not tell us, the classic line. Absolutely. Thanks, Tim. And leading on from that, Noah, from a different perspective, international perspective and wholesale, do you think that this guidance is necessary in this market at this time?
Well, we've definitely come across some of the issues that are highlighted in the guidance in the wholesale market. For example, active strategy being replaced by passive strategies without necessarily the right change in fees. So I think that's one of the areas that I think is interesting to look at. Now, in the wholesale market, you have people like ourselves or our competitors who can help investors assessing the fees and potentially negotiating fees. Obviously, in the retail space, that's not possible, and especially for people with small balances, it's very hard to get quality independent advice. And then I think it's also important to realize that there's still this significant information asymmetry between the suppliers and the consumers. So I think, yes, there's a role for the regulator to play here, and some of the issues that are highlighted need to be addressed by the industry.
Smaller balances can get access to advice, by the way. Talk to your bank or... Anyway, right, so carrying on to Sharon here. So from a fund manager's perspective, how do you view the guidance? Do you see any positive outcome for investors? Any unforeseen circumstances?
Yeah.
Big question.
It's a big question. It's a really, really big question. And I think, coming in and deciding to sort of be part of this sort of panel conversation, the first thing that struck me is, what is the problem we're really trying to solve? So do we really have a good understanding of the problem that either we are facing into today or that we want to avoid in the future? And I can't actually say I'm sure that we do. So, well, I think guidance is always welcome, and I think it is always useful. I don't know that it will deliver, particularly in the short term, much change. Okay. My concern, I think, is that short term it does become a little bit of a box-ticking exercise, because it's incredibly resource heavy to go through and look across your business to try to validate on a little bit of ambiguous concepts as well. And then for supervisors to have to sort of deal with some of that ambiguity and try to make sense of what each fund manager is saying relative to each other in different language, different contexts, and different displays of where they place their value, I think it's going to be slightly problematic. I also kind of think when we think about value for money, what does it really mean? So value for money for me is different than value for Harry, is different from value for Tim. So if we can't kind of come around it from a customer or a consumer or investor basis, how can we land it effectively? Looking through the guidance and I guess the feedback that we've seen along the way, there's not a lot of talk about customer. The intent, I think, is obviously customer, but do we really understand how it will land for those customers? Do we really understand what they want? And do they really understand what value looks like from their perspective? So choice, I think, is the one thing that this industry can be proud for delivering. But the other thing I think that often comes out in these conversations is New Zealand is at scale, and those scale benefits are not being passed on. I'm not entirely sure that I would 100% agree with that. I think New Zealand is still growing and maturing, and yes, we've had a phenomenal success with KiwiSaver, but the ask of what we do every year increases for all of the right reasons, but scale is not something I think that is intuitive in our market today. When I was kind of thinking about scale, how do we know if we are or aren't at scale? Just a couple of quick things that came up. I had a wee look. 30 KiwiSaver schemes in New Zealand is quite a lot. Population 5 million, 30 schemes. When you look at sort of 90 odd billion roughly invested, and you break that down on an average, just going on a really, really simple comparative average, that would be sort of 3 billion per scheme. Doesn't feel very scalable to me. If you look across the ditch and you look at our colleagues in Australia, they've had a longer history, and they obviously, we all know they've got a much, much bigger pool. They've got 158 schemes. So excluding the small schemes with less than 7 members, 158 schemes, 3.3 trillion invested, and an average of 21 billion across those schemes. That feels more scale worthy, but we're not seeing relative difference in the levels of fees New Zealand to Australia. Okay. So I just kind of think we have to sort of look at New Zealand and think about what's achievable while we continue to lift up the ante on giving advice. It's really, really important to make it available. It's really important to encourage investors to access it. It's really important to deliver financial literacy. It's really important to deliver great performance. So how we balance those, I think, across the board. Harry, I think you're up for an interesting challenge.
Yeah, and I will say, Paul, you'll get your chance. Harry, do you agree with this? I mean, there's been a huge amount of time spent on it from a supervisor perspective as well, so...
Yeah, and I think, as Paul said, it is about value for money, right? And we think that the process that also bring is for managers to go through that robust assessment. And it's not, as Paul said, it's not just about fees, it's a value for money. And that manager can demonstrate that they've gone through the process, they can demonstrate to their board that they are delivering products that deliver value for money, which is good for the investors. Ultimately, that's what we are here to act for your customers and for us to act in the best interest of investors. So I think it is quite important to go through that process. The outcomes of the process obviously will be reviewed, and we will undertake our assessment. But I think 2 key areas here that have come out of our pilot and that FMA have highlighted that need further discussion. It is about performance benchmarks and market indices and how those are set and whether they're appropriate, and also commissions and advice. And I think that's something that as an industry we need to have that discussion sooner rather than later, because as supervisors we are all getting already starting to field questions from the managers on some of those technical points. So those are the 2 key areas that I think that we need to address as soon as possible, and have that industry discussions to try to achieve consistency as much as we can.
And one of the questions that's been brought up a lot is talking about innovation, and whether this is going to stifle innovation or whether it will lead to us being more, when we talk about it's not meant to lead to more passive investment, but will it by design mean that we'd see more passive or more traditional index-led investments rather than absolute? Paul, do you have any views on that?
Well, we're certainly not aware of any examples of value for money stifling innovation at this point. And really, isn't it far more likely to have the opposite effect? To support and shine a light on innovation. If providers see the opportunity to meaningfully differentiate themselves on a value basis, and that can be innovative approach to cost control, it can be innovative approach to how they generate ideas and manage portfolios, including in an ESG sense. It can be about how they help their members, whether that's through advice or some other channel. So I think it's more likely to do that, and we're seeing that, and we're certainly not seeing things that have been suggested to us or early stage conversations with us that haven't been withdrawn because of value for money considerations. And the FMA and supervisors want fund managers to demonstrate the value for the fees that they're charging. What we're not doing and what we won't be doing is in any way preventing access to products which meet an investor need, which are well managed, and which may be higher risk and which may just also happen to have higher fees. So it really is a value perspective. And the answer to the question of what is value and is there a consumer perspective in the guidance, I think it's all through there. It is about, as I say, people use fund managers to get returns, to get risk-adjusted net returns as a compensation for the risk that they're taking and the fees that they're paying. So that's one consumer perspective on value. Another is on help to make good decisions, so advice or something which serves the same purpose as advice. And there can also be, as we're all aware of, increasing expectations about having an investment process and investment outcomes which meet values. That's another outcome, that's another quantification of value. As to does New Zealand have scale? Before actually the pilot study was even done, and shortly after the publication of the guidance, we of course had 5 to 6 providers who reduced or eliminated fees, explicitly referencing value for money and scale. So that was a very New Zealand specific indication of scale, and I think there's been a couple of reports recently, including the one that David Chaplin did, that picked up what the discounted fees was across the system as a response to value for money. So I look at what the industry's actually done in response, and I think there's probably a pretty persuasive scale argument there, at least for some of the industry.
Okay, and we'll talk about a certain report that has had a few questions through in a moment. But first of all, I'd like to just go to Noah on that point. There's a lot of talk here around being relative to benchmark. We all know that there are fees that perform in some markets and don't perform in others. So how do you see that when it comes to relative performance? Is that the best way to look at value for money? Do you have any thoughts about that?
Yeah, look, the answer is yes and no. Obviously, performance is what matters over the long term in terms of how your account balance changes. What I think is important to consider as well, that in investment markets, luck does play a role as well. It does impact performance as well. And, to use an extreme example, if I close my eyes and pick 10 stocks out of the 50 in New Zealand, could be that I'm outperforming the market next year. But obviously, that would not be great value for money, although the performance looks really good. So I think it's really important to look at how these performance measures are used and over what time frames, because definitely over shorter time frames, luck can play quite a big role in terms of determining investment outcomes, unfortunately.
And we've obviously seen in Australia that they've gone to a set time period to look at the performance period. Do you have any view on that?
Yeah, so I guess there's this performance test now in Australia that was introduced by APRA. There's a few issues with that. There's a great report by an Australian consultant that sort of talks about some of the issues. One that I think is important to highlight is asset allocation, the importance of asset allocation. It's not just about how you perform against the benchmark, it's also about how you decided on your asset allocation. And in Australia, that has led to results where you have funds that have underperformed the benchmark and therefore failed the test, but they have actually performed better than other funds that have passed the test. And I think that's just something that I think has to be approached with caution in terms of trying to sort of replicate a test like that here in New Zealand.
Good call. So one of the things I wanted to touch on was the relationship between the supervisors and the FMA at this point. So at the moment, the information review sits with supervisors, and as I understand it, it's not passed on to the FMA, but we've talked about it that, Paul, that how will you guys get a good view of what value for money looks like within the market if you're not sort of getting that regular feedback on it? And are you relying on supervisors and their experience with MIS managers as part of this process?
So there's no doubt that the guidance talks about this primarily being an interaction between fund managers and supervisors, and a pretty fundamental part, as far as we're concerned, of conversations that would have been happening anyway. But it is normal for us to look at examples of what supervisors do with their clients, and we just do that as part of normal sampling, so we would do that. We've also said that if a manager refuses to engage with a value for money process, or there's a disputed outcome, that we're very happy to get involved at that point. And we also see, of course, we just witness in the market, often because it has to be reported to us directly, what managers charge, how they change their services, how they invest in their businesses. So we'll see the outcomes from value for money and take an interest of those independently, or whether it gets reported to us or not. And we'll also continue going straight to investors and members to ask them what their experiences are of value for money from the various perspectives that they define it, because absolutely value is a personal perspective outside of the main things of returns and getting help to make good investment decisions.
And as a follow-on to that, Harry, as a manager, when you're looking at supervisors, given that you will be doing a like-for-like comparison for MIS managers, is it an advantage or a disadvantage to have greater amounts of MIS clients? And how should we be viewing our supervisors in that way?
Look, I think it is both ways. I think it's advantage to have a broader pool of clients that and managers that operate and offer a slightly different product and how they are structured. But I think it's important to know that through CTA, which is Corporate Trustee Association, some of the general themes that come out of that and they encounter the difficulties and industry discussion, that will be discussed at a general level, at a high level at supervisors, and we will be engaging and discussing those with FMA as well. As Paul said, supervisors meet with FMA on a regular basis to discuss a wide range of issues. So if we are encountering issues, we will look for clarifications and guidance as well.
I'm going to quickly dive into a few questions because they are coming through, but a lot of questions around the Deloitte Generate survey that came out, which showed that fees for KiwiSaver fees were competitive, already lower than much bigger and scalable Australia and UK markets. I might go to you first, Paul, on this. Do you have any comment on that?
Yeah, 3. So obviously we're really happy with research and data about this, and anybody who's heard Sam speak knows the economics background and the interest that we have in having economics underpin much more of the work that we do in all sectors, including in the managed fund sector. So in terms of a contribution to the data and understanding, yeah, big tick, thank you. In terms of a couple of the points, it did of course just focus on fees, so it is by definition not a value for money exercise, and so we just think that it's difficult for it to be a truly meritorious outcome if there's no conception whatsoever of what the value was that was provided in return for those fees relative to what was in the other market, so there was no conversation about performance. I guess second, the period covered by that, which showed the reduction in fees, would have covered the initial significant impact from value for money on exactly those organisations that we talked about. So actually it was a pretty good demonstration of the value of government intervention in terms of default settings and value for money. So we welcomed it on that basis.
Sharon, anything you'd like to add to that?
I think, so fees are important and we can't ever step away from the fact that they are really important. I think when you look at sort of the reports that are coming out and you look at the New Zealand setting, the New Zealand market, how we stack up to global markets, I don't think we could ever say that we're not doing well. I think we're doing phenomenally well given where we started from and where we are today, and really still coming back to that we're at the beginning of this journey, not even at the midpoint of it. We're not even yet into 20 years old, so still a long pathway ahead of us. If we can get the balance right and we start to really think a little bit more holistically and start, I think, to change the language around value for money and centre that around a client, that's going to drive, I think, better outcomes. When I think about kind of reports, I think they're really useful tools, but they're just a point in time, right? They just are a pure point in time. To Paul's point, and again, sort of looked at a couple of wee figures, no surprises. Things like administration fees on an average basis, taking it out of Morningstar reports, they've gone down by over 50% at a global overall KiwiSaver level. Investment management fees or fund management fees have gone down over 10%, and that's only since 2013. So quite big changes in a relatively short space of time. I think every now and again we will have to come back and take stock and look at where we are and where we're going. But I do worry a lot about will this potentially favour larger players over smaller, more innovative players? That I think is going to remain to be seen, and I don't think we will see that for a few years. So we know intuitively that the players coming to market today, they are smaller, it's taking them longer to build up the scale at a relatively substantial level to I guess, give them the profitability to reinvest in their business. Is that going to lead to more consolidation, M&A and activity? I'm guessing so over the next 3 years. Is that a good thing, or are we just going to supersize the bigger players to another level?
So now, from your experience offshore, have you seen that sort of thing happening? Obviously this is just a mechanism to look at value for money. We should all be thinking about it in our day-to-day operations, but...
Yeah, I guess I think overall we're probably, in relatively good shape here. I think it's important to realize that it doesn't look so bad, and it's not necessarily that the offshore markets are far ahead of where New Zealand is in general. I'm originally from Switzerland, which maybe many people consider as sort of a top market for wealth management. But if you actually look under the hood, you'd find out that there's many issues there as well. So I think we shouldn't sort of underestimate how far the industry overall has come. And there's a few things to improve. That's always the case, but I don't think there's a massive gap necessarily to some of the markets offshore.
Okay, cool. Multitasking here, peeps, bear with me. I might go to Tim, actually. There's a question here asking about, is it more about how fees are disclosed to consumers and explained in dollar terms, and we need to show more about the total expense ratio? Is there an element of disclosure as part of this that we need to change, do you think, or is there anything within the legislation at the moment that needs to be tweaked?
Disclosure has been at the absolute centre of securities law around the world and in New Zealand for a long time. So this is bringing back the market forces point. You can't have competition working successfully without knowledge, and so disclosure has been a very important part. Now, the PDS has quite detailed disclosure about manager fees already. I believe they're quite successful in giving the necessary information. On commissions, there is disclosure, particularly through the FSLAR reforms, from the financial advisors. And that's in the disclosure statements that they produce and on their websites. So there's quite a lot of information around it. I think there is on the tick on transparency, I think Morningstar does an international survey, and transparency New Zealand does quite well on relative to the rest of the world. So I don't see there needs to be a great deal of change. That segues into one of the points is do we need to have in PDS's disclosure about the commissions that fund managers are paying from their own pocket. And my belief is you don't, but if the FMA wants it, why not put it in there? There's no harm. It's out there in the market anyway. Should you be disclosing fees that are being taken from the scheme or from member balances? Yes, I believe you should be doing that in the PDS. So I draw a distinction between manager-paid commissions being disclosed and the commissions that are coming from the scheme as far as disclosability goes.
And all trying to do that on a limited PDS word budget as well.
Yes, the word budget is quite lean, isn't it? And we come across it often.
Yeah, we're all starting to use very simple language. There'll be lots of bullet points, I'm sure, but I think they're even counted, which is great. So I did want to nip into, as we say... Right, there's a question here about Samantha Bellis, who confirmed that the value for money workbook is mandatory, but even without it, the compliance cost resource drain will be huge. If customers' outcomes are the true aim, why not focus on the outliers, e.g. those identified as having erroneous performance fees? Supervisors already have the data required for outlier identification. Harry, what do you reckon?
I think that the focus will be, and the focus through the pilot and some of the managers that have put their hands on it, that was selected, is on not sure what is outlier is and how that outlier will come through. But I think sometimes you do need to take a bit of a review as well and undertake that assessment to find out who is potentially an outlier as well. So look, there will be focus on two things that I mentioned earlier, and there will be a focus on appropriateness of the benchmark for performance fees and benchmark in general, and there will be a focus also on advice and trail commission and just making sure that there is no fee for no service there. So look, that is something that supervisors will look at a bit closer as well, but at the same time, the managers should go through that review and should assess whether they're delivering their value for money and whether those services that they are providing, it's not so much around the amount of trail commission or advice fees, it's what service is provided to justify those fees. That will be quite important, that we'll be looking at as well. So some of the information supervisors do have, but some of the information supervisors will have to obtain, but at the same time it is a review that the manager has to undertake and present to their board, and their board has to be comfortable as well before it comes to us for review as well.
So it's a massive piece of work, and all pieces of work cost. So I guess the question is, given that this is covering absolutely everything, is that viable? Is there too much cost? Could that cost be passed on to end consumers as well? Sharon, do you have any thoughts on that? So guys.
Look, I guess my gut feel is it won't be passed on to consumers, but it may, at the worst case, and my hope would be this doesn't occur, rather than passing on kind of those incremental year-on-year reductions as expenses go down. Well, expenses just won't go down. And I think, we also have a really unique situation that we're facing into today, where inflation is high, cost of living is going up, wages are going up, cost of performing services is going up, but our fees will not go up. So you've got some really interesting pressure points now, I think, building within the system that we just need to be aware of.
And I guess I'm going to go to Paul to say, is now the right time to do this? There's a huge amount of infrastructure within businesses, both with supervisors and with managers, to implement this. We're in times of volatility, we are very focused on the markets, there's other costs going on for managers that are increasing. Is now the right time to be looking to implement something at this scale?
I think from an investor or a member perspective, your manager being prepared to demonstrate value for money for you is a permanent need. In fact, probably arguably more so in volatile market conditions. And a lot of the cost and inconvenience argument seems to attach to the particular self-assessment tool that's been put out as a response to a request from the industry that such a tool would exist. But it is, of course, open to managers, as we've said a number of times, to demonstrate value in their own way, provided it's convincing. So I think as well that this isn't like a peripheral discipline. It's not like we're asking for people or for investment managers to show us something that's not core to their operations, that their investment committees, that their institutional investors and independent directors wouldn't have been asking them at least once and probably more times a year anyway. So in terms of what the additional burden and everything is, I'm not sure what that would be, but of course there could be individual cases of that, and we've also said let's hear about that. But it is about demonstrating value for money as is particular to your approach, to your members, to your investors, and we think that's valuable and should be being done anyway.
And I'll also go back to Harry on this, but I've had a couple of supervisors saying to me that we spent 3 months on this, there's a huge amount of work gone into this tool. It's now being said that the tool isn't compulsory, it's you could use other methods to demonstrate your value for money. How do you feel about that?
I think as supervisors, we would encourage managers to utilize the tool, but as Paul said, it's not a mandatory, and managers can come with their own assessments to demonstrate value for money. But I think it is important to know that the tool is a tool, and the questions that the tool is asking for managers to address are no different what was set out in the guidance. And the tool has actually simplified certain areas and said, look, if demonstrate these, but if you don't have performance fees, if you don't have trail commission advice, it can be it does not go into more detail. So I think it is important to for managers to engage with their supervisor early. To start that discussion. The discussion should have already started as to, whether they will be utilizing tools. And look, a manager who has 1 or 2 funds, it might be appropriate for them to use tools, but a manager who has 200 funds, 150 funds, there might be other ways that this information can be presented and demonstrate, and their data as well, that is important as well. And I think as CTA, as we set out, we will review the tool after the first year. We we will take feedback from the industry, and we will engage and to see if there are ways that we can improve it for the following periods, and we will discuss it with FMA as well.
Okay. And Sharon, are you supporting the use of the tool?
It's a big document, right? So I don't know that you can kind of step away from that. It is going to take a lot of effort to complete it. That doesn't necessarily say that it's wrong or right. I think when you start to say, here's something that we've developed and delivered, and now it's kind of optional, I think it's going to be hard to get that comparability and relativity around if you are using it or you're not using it. It's going to make the job, I think, of supervisors possibly a little more difficult to really be able to assess managers on a fair and equitable basis. And if you have some supervisors that say less adhering to use a tool, so do whatever you like, take your own premise, and then some that are requiring managers to, you run the risk of lack of relativity now across your supervisor base as well. So, look, I don't know what the right answer is, but I think to get it up and running and to get consistency at the get-go, generally I would be more supportive of using it just to start to measure and come up with the right set of metrics, then look to refine it over the next 2 or 3 year period.
We've got an earlier question to say, have we seen any unintended consequences of value for money rollout? And if so, what can we learn? I'll actually probably stick with Sharon on that.
Oh, I feel like I'm in the hot seat. I think, I kind of touched on unintended consequences a little bit before. So do we, as a market, end up in a position where the size of some providers is detrimental to newcomers into market, and how they start to galvanise that position, and how they really are able to demonstrate their unique proposition to a wide range of customers. We know that KiwiSaver members are not generally that transferable. That seems to have settled down quite a lot over the last few years. Helping customers make the right decision about their scheme is incredibly hard when they can't make the right decision today about their fund. So, I think the worry for me is that innovation takes a back seat and we end up with a fairly kind of broad vanilla industry around KiwiSaver. Now maybe that's a good outcome. I think it's probably not, particularly as we continue that maturity and we're seeing more people choose to hold their funds in KiwiSaver post-retirement.
And Noah, from a different side, is that something that you think you can see coming through?
Yeah, that's interesting. I mean, already now we see that a lot of providers are obviously benchmarking themselves against everyone else in the market, and everyone's looking at what are the asset allocations of other providers and so forth. So yeah, there is possibly a risk there, but whether that would not have happened anyway naturally, that people are starting to be a bit more peer aware, I guess, is a different question. So yeah, there is a risk that innovation is sort of slowed down. So yeah, it's important not to get to that point. But I think already now you can see that even before value for money, providers were looking very closely at what others are doing. So which is sort of, I guess, a similar outcome to some degree.
And Paul, from your side, we've got a question to say, at what point will investors be involved in this? Is this something that the FMA has taken into account in its processes?
Yes, so there's a lot of work that we and other people in this market and other markets have done, which is about what is the effectiveness of disclosure and of literacy efforts generally on the choice and use of investment products, and it tends to be pretty low and difficult to establish because it required to demonstrate over a long period of time. And so a lot of the work that's done on this says that if you're a regulator, you need to focus your attention on the provider so that the settings improve regardless of whether the sophistication of the investor changes or not. So that's part of the reason why the guidance was very squarely focused at fund managers and supervisors. But we did say in the guidance, and rather like they have done, of course, in the UK with the approach that the FCA takes towards this, which is you need to be able to succinctly demonstrate this to your members directly as well. I think they've got a one-page requirement for that, which managers, and some of those are pretty impressive pieces of communication. Now, again, it was guidance, so we used the word strongly encouraged fund managers to consider how they would do this, but we think it is definitely worthwhile. But I think if fund managers want to consider that as part of their approach to value for money right now, I think that's great. If they would prefer to get their internal processes and how it works with the supervisor within us established first, and then think about how it's communicated directly to members, then that would be an entirely understandable position to take as well.
Okay. And I always think that coming from years in the UK and working with UCITS funds, those funds, it's a requirement to have an aim and disclose an aim for the fund. So it's a 1 or 2 line thing that basically says this is what we're aiming to do, and it's a lot easier, I think, on that basis to be able to say this is what the fund is, this is where value for money is seen in it. Do you think that would help this process at all, for you to be able to identify what is it they're trying to achieve rather than just checking out the benchmark?
Certainly, in particular, all of that, getting into this also suggests your target audience. It certainly should suggest as well your market index, and then it also allows an understanding of what capabilities you're trying to bring, that sort of thing. So, absolutely.
Okay. I'm going to run into performance fees now. Warning. Okay. So. We've got a question here that picking up on performance fees, what does the FMA think about the longevity of these? And I'm putting you in the spotlight at the moment, Paul. But what's your thoughts on the longevity of performance fees?
So the FMA doesn't have a philosophical opposition to performance fees when they're well structured. They can be a very good tool for aligning investor and investment manager interests, provided they're well structured. So that includes benchmark, it includes various features like clawbacks, that sort of thing. So I think the future of performance fees will be on their structure, demonstrating how they're value for money to the people who are paying them, and how well they're disclosed. So I think that's the future of performance fees.
Okay. And I will talk to Sharon because I know that you run performance fees. So what's your thinking on that, the longevity, and also the appropriateness for retail investors?
So I guess our view is that they do provide a really good mechanism for aligning the investor and the investment team together on the same outcome. I think, benchmarks are complicated things, right? Benchmarks are horrendously complicated things. To try to get a consumer to understand a composite benchmark feels like a nightmare, and I don't think it's going to add any value to them because, talking about the NZX 50, the MSCI worldwide, what are they supposed to take from that? But when you have simple benchmarks that they can relatively look at and sort of understand and gain a reference point to, I think that's where we draw our background from. So we really wanted to make sure that what we were demonstrating, what we were taking out was simple, easy to understand, and easy for a person to connect to, even when they were walking down the street. We fully know today that members look at a bank billboard, they can see their term deposit rate, and they take that and they apply that to their investment. This tends to be the way that it works because I understand that. I don't necessarily understand this concept of benchmarks, this concept of peer relative, this concept of a bunch of other things. So look, I do think there is a place for well-structured, well-communicated performance fees.
And no, I might come to you on that same question, given that you're coming from a wholesale perspective. Retail, wholesale, what do you think the usage of it is?
Yeah, look, it's all about how you structure them. I do think benchmarking is an important part of that, to have an appropriate benchmark for your performance fees. That's definitely something that we would recommend to our clients if they look at performance fees. So it really comes down to how you structure it, and then, yes, as Sharon said as well, just being very transparent about how does your performance fee structure work. But yeah, the benchmarking and probably sort of high watermarks are sort of two important components, I think, that should be part of performance fees.
It's an interesting one, though, when we're talking quite a lot about capability and etc. But I'll leave that. It's not a topic of discussion today. Okay, we'll go over to Tim. We've got a question here. In your view, is your view that disclosure is an effective methodology for good customer outcomes like value for money?
Goodness. Having grown up in that world where disclosure has been absolutely key, I have a belief that that does lead to good outcomes for customers. Principally, even if you've got an unsophisticated audience, they can get very well informed by either seeking advice or actually talking to people who they know that are knowledgeable. So it's not just a target for the disclosure is not just a target to try and educate unsophisticated individuals. It also creates a pressure on fund managers themselves because they know that sunlight being the best hygiene, they know that they're going to have to disclose these figures. There are good journalists out there who will identify if they're out of kilter with the rest of the market. That is sort of the fundamental of the Adam Smith and capitalism in a way. It has worked successfully across the economy as a whole. So I think it is sufficient. Does it help to have a regulator occasionally chime in and draw attention to fees for customers? Maybe it does, and that's something that the regulators can do if they think there's merit in it. I think just to on a slightly change of topic in a way, I think it is something that the FMA is entitled to do, but I think that they're not prejudging it, and that's an important point here as well to emphasise, is that the FMA has raised this question, as it suitably should do, but it's not saying they've found fault yet. They're rightly inquiring as to, is this acceptable, and asking the supervisors to confirm this, and that is, I think, an important point to bear in mind in the context of this whole value for money point.
Good answer. And as we push closer to the end user of funds, the use of advice and consultant-driven model portfolios and DIMS comes more into the picture. To what extent are these services also captured by aspects of the value for money review? Paul, is that one you want to take?
Well, I would have thought from just a conduct expectation that anybody who's offering those sorts of services, including DIMS, would want to demonstrate value for money. So absolutely, the concept of value for money and indeed the underlying duty to act in the members' interests is the same. So yes.
Succinct. There we go. Right. So we're just sort of heading to the end of our period, so I will go through for each of you and just ask for your final thoughts. What's the direction of this? Any next steps that you'd like to see? So we'll start at the end. Tim, off you go.
Oh, thank you. I think I've said already that it's now over to supervisors to respond to the FMA's inquiry, to make the inquiries it needs to make, to be able to be confident to give the regulator the assurances it needs. I encourage the supervisors to apply the law if they're talking about matters of law. If they're talking about matters of encouragement, be transparent that that's all it is, so that there's no confusion in the marketplace between the two of those things.
Great, thank you. Noah?
I think we haven't sort of talked a lot about the role that advice can play in terms of adding value. So a couple of years ago, I think we had a session at this conference about switching and keeping someone from switching. If you think about the long-term outcomes, that's massive amount of money. And just to clarify my earlier comment, it's difficult to get independent advice. It's not difficult to get advice necessarily if you have a small balance. But so the role of advice, I think, can be really important, and hopefully that will be something that will come through over time as well as sort of value for money for customers.
100%. Yeah. Sharon?
Gee, what would I say as closing remarks? Take a breath, take a pause, really think about what it is that we are looking to step into in the future of this market. So as we work together to really define what is value for money, ask a lot of questions and push for a lot of answers. I would say the worst thing that we could do as a marketplace is look at the task in front of us, complete it, hand it over to supervisors, and then walk away and think that we're done. If it takes a tool for us to really think about our businesses, I think we do have a problem. The reality is I just don't think that does exist today. So to really, I guess, I challenge us all to to really think about what is at the heart of what we're trying to resolve here. I think the point around advice is really critical and really key. There needs to be much more of it. We all know it, but our investors haven't quite figured that one out yet. And as Kiwis, being a nationwide lover of DIY, we've got a task ahead of us, convincing people they do need it and convincing people there is value in it. So I think probably the next thing needs to be the value in advice.
Great stuff. I wholeheartedly agree with that. Off you go.
Yeah, and I think I mentioned it earlier. I think the key from supervisors' perspective is that the managers engage supervisors early. Talk to your supervisors, take them through your thinking process, take them how you think you're going to approach this review. How will some of will view general aspects of the tool, whether you will use the tool, whether you will demonstrate this differently. I think if you leave it until April next year and give supervisors all the information and think you might not get any questions on my take, I think that's not a good way of approaching it. And I think that engagement and supervisors will work with with managers to make sure that the approach is. We'll try to achieve consistencies, as I said, but that early engagement, it's very important. And I think we even encourage some of our clients who have a lot of funds, look, pick 2 or 3 funds, turn your mind to it, make sure that you have a framework how you're going to be doing that, and we'll help you. So, yeah.
Great. Thanks, Harry. And final word to Mr. Paul Gregory.
Just the final word is supervisors, the FMA, fund managers, are all trying to do the same thing. Like I said at the start, we're all got a deep professional and personal interest in New Zealanders having good financial outcomes over a retirement horizon or over a first home horizon or over an investment goal that's outside of KiwiSaver that's particular to them. And the FMA has a role in that. We're a regulator. Regulating is what we do. Some of it is with clear sort of enforcement capability, and some of it is with influence, and obviously value for money spans both. We think it's important, we think it's fundamental, but I don't think there's anybody in the room that disagrees with the fact that being able to demonstrate and indeed to actually provide value for money to your members and investors is important, and that there are different approaches to that, but I think it is important to show it.
Fantastic. Please join me in thanking the panel. No one's been murdered. It's great. So thank you for your time.